Hello and welcome to the AIM Summit webinar on Bitcoin and Beyond with Jack Totter, co-author of Crypto Assets, the Innovative Investor's Guide to Bitcoin and Beyond, with Fred Pai, the chairman and CEO of 3iQ. I'm your moderator, Zachary Zevarati, the CEO and founder of Dalma Capital. We have over 45 countries participating in the session today. Amongst you are institutional investors, family offices, high net worth individuals, and the leaders of the financial services industry. Please feel free to submit your questions on the Q&A dialog at the bottom of your screen. We'll be taking those questions throughout the session. Most of them will be towards the end of the session after a fireside chat. But please, again, feel free to submit the questions as they come when you think of them, and we'll be picking up those questions throughout. If you're joining us after the fact on YouTube, please like this video, subscribe to our YouTube channel now. Go to aimsummit.com to sign up for the live session so you can be part of the Q&A with our speakers. Introducing our webinar partner, 3iQ. Founded in 2012, 3iQ is a Canadian investment fund manager focused on providing investors with exposure to digital assets, disruptive technologies in the blockchain space. 3iQ was the first investment fund manager to agree terms and conditions with the Canadian securities regulatory authorities to manage a public Bitcoin fund and a multi-crypto asset fund for Canadian accredited investors. Access to these new technologies can be daunting, costly, and inconvenient, but 3iQ has worked through a stringent regulatory process to offer investors convenient and familiar investment products to gain exposure to digital assets. Again, I'd love to introduce our partners today who are going to be joining me on this session. Jack, you've been in the crypto industry, writing about, speaking about, telling us all about the crypto industry for several years. You published multiple books. Please, if you wouldn't mind, before we really get started into the session, telling us a little bit about your background, how you got started in Bitcoin, and your continued involvement, as well as your involvement with 3iQ.
Well, thank you, Zach. I appreciate it. I'm glad to be here and appreciate the opportunity to speak to people. I've been involved in crypto since 2013, and I'll give you a little bit of history about myself. Obviously, I'm not a young guy here. I've been around the financial world for a while. I spent nearly 20 years with Merrill Lynch, large wirehouse here in the United States. I was a financial advisor for much of that time. And then I worked in the heading up aspects of the field marketing for Merrill Lynch, which worked directly with advisors. And then I ran a market research firm that was specifically geared towards working with financial advisors and the financial firms. And it was interesting, back in one of the projects that we were involved with from the financial services companies was to keep an eye out on new technologies that were out there, competitive, disruptive type of technologies. So back in 2013, I really started to kind of become aware of Bitcoin, and we did a research report on that, which we turned into the first book published on Bitcoin, called "What's the Deal with Bitcoins?" And at the time, I was writing for MarketWatch.com about retirement, because I'd written a bunch of retirement books, and I started to take a look at the potential for Bitcoin as an investment vehicle, and specifically for retirement, as a way to kind of achieve and address the retirement crunch that many investors have. So I took a good look at allocation models and the reality of if Bitcoin is an asset class, and I did a series of articles along those lines. I really fell down the rabbit hole around Bitcoin at that time. I really felt that it was an investment product. A couple of years later, I connected with Chris Burniske, and we wrote the book together, Crypto Assets, the Innovative Investor's Guide to Bitcoin and Beyond, which was geared towards investors and financial advisors, really calling out the reality that Bitcoin is an asset class and should fit into people's investment portfolios. And since then, been very much involved in the space. Have invested in a number of companies involved in what I call transformative technologies. I've known Fred for pretty much since he began. I'm an advisor and an investor in 3iQ, as well as many other companies. So still kind of involved in the space, and it's a very interesting space, and I'm glad to see it finally being adapted as an appropriate investment vehicle for institutions and investors overall.
And so, Fred, how, I mean, given the background that Jack has in the financial advisory space, how important was the advent or the introduction of listed funds in tapping into the financial advisory client base, and what are some of the key differences that financial advisors? Why is this time different for financial advisors making, after Jack convinced them that this is an investment product, an investable product?
Yeah, that's a great question, Zach. I'm going to start off by saying Jack is way too modest in the impact and influence he has had on the crypto industry. Certainly in my life, and the first when we got involved, kind of 2013-14, Jack's first book had already come out. But it was me meeting with Chris Berniski and Kathy Wood from ARK Invest and a number of Jack's colleagues, where we said, we'd love to be able to invest in Bitcoin in our ETFs or in our mutual funds or in our, the different products that we manage as portfolio managers. But there was no physical way to do it. And I always can like to, in the early 1980s, everybody wanted to put gold in their portfolio, but there was no way to get gold on your statement at your brokerage firm, right? You had to buy a bar of gold and you had to keep it. So as we did in terms of my career as listing gold, silver, and platinum on the Montreal Stock Exchange in the early 80s, we went on this quest to list Bitcoin, to give the everyday access to Bitcoin to not only to investors, but give the option for investment advisors that are kind of leaders in this space, give them access for their clients, because they don't want to lose their clients. But Canada had a couple of highly public disasters of people buying Bitcoin online, and the very famous one of Quadriga CX. The owner of Quadriga CX went to India on a charity event or to do some charity working in an orphanage over there, and unfortunately got very sick and passed away. And he had all the passwords for over $240 million of Bitcoin, and 110,000 Canadians lost all their money. The second was a Flamboyant Group from Vancouver had an exchange called Einstein Exchange. Well, Einstein wasn't that smart in terms of being used for an exchange, and they went bankrupt, and other Canadians lost another group of money. So one of our big challenges was to be able to convince the regulators, which took 4.5 years and $5 million of due diligence on behalf of the regulators, to realize that we could create a safe, secure alternative way to investing in an asset class that's very difficult for people to get exposure to. And that was the quest. And we had Jack and Kathy Wood, Chris Berniski, Winklevi, everybody came to testify in our public hearing, or came up at separate panels to discuss with the Ontario Securities Commission. So Canada really became a leader in this space, and we're happy that Jack's been a part of it.
So, Jack, I'd like to talk a little bit more about the importance of financial advisors in this ecosystem, and what you've had to go through to not only again take this from being convincing them that this is an asset class, convincing this investable product, but actually seeing financial advisors start to allocate their clients' funds to it. If you could maybe give us put us in the brain of a financial advisor. You were sitting, consulting these guys. You have a background in financial advisory. Why, in their mind, is going and buying some Bitcoin on Coinbase not something that they can do for their clients? Why are products like some of the listed products necessary for them to make this investable for their clients?
Well, Zach, this is probably something we can go on for hours about, but I just want to say I have the utmost respect for financial advisors, And I really believe that they play a very valuable role for investors. I mean, right now we're seeing investors, I'm sure anybody involved in crypto is getting phone calls from everybody, from the plumber who comes over to your house, who asks you about Dogecoin, to to a business leader who's like, how do I invest in Bitcoin? And the reality is that our financial advisor community is qualified, is trained to be basically fiduciaries and responsible for helping people to reach their financial goals and objectives. And the large majority of financial advisors fully believe that and are trained to be in those positions. And what ends up happening, what has happened, is most financial advisors spend their time, obviously, addressing the client's needs and goals, but they also spend time creating portfolios and allocating assets based on a client's financial goals and objectives. So an older client such as myself is probably going to be more conservative than a young millennial who can be more aggressive with growth. So putting together a portfolio requires the knowledge of a financial advisor. So when I started to look at Bitcoin and where it fit into a portfolio, for me, it was very simple. Bitcoin fit an allocation sleeve of alternative assets. And for those who may not be familiar with portfolio construction, we always fall back on the 60-40 model, equity 60% and bonds 40%. And right now, if you're investing in bonds, you need to get your head examined, but that's a whole nother point. But in the financial crisis of 2008, we started to see more advisors take a look at what were called alternative assets. Fred mentioned gold before, real estate, private equity, those types of things. So for me, and they're non-correlated assets. They're assets that basically, if the stock market goes one way or the bond market goes another way, there's not going to be the correlation that you saw with the stock and bond market. So it fits a sleeve in a portfolio for alternative assets, non-correlated assets. And I spent a lot of time taking a look at Bitcoin, which was very difficult at the time because Bitcoin didn't have the history that it has now. So trying to pull it apart and say it's a non-correlated asset and all of those types of things was not easy. Well, now we can really see, after 12 years of history, yes, Bitcoin has been out there for 12 years, that I think it essentially fits within an alternative asset part of a portfolio. So when an advisor looks at putting together a portfolio for an investor, they should be taking a look at Bitcoin and crypto assets as an alternative asset, which means that probably fits somewhere from 5 to 10, potentially 15% of a portfolio. And what we've seen is advisors are not being allowed to even speak about that from their firms. Their firms are basically saying you cannot talk about Bitcoin, and they are denying investors, and they have denied investors the ability to invest in the best performing asset of the last decade. And to me, that's fiduciary malpractice, because investors who listen to their advisors have really missed out on this run up here. And I think it's frustrated advisors, but they're under fiduciary rules. So that's why, and additionally, one other point about this, you mentioned about Coinbase. I'm going to tell you, when you go in the mind of a financial advisor, they are not going to tell their clients to go and invest in Coinbase. And it's a very simple reason. Most advisors are being paid on a fee-based basis. So they get paid on fees under assets under management. And if they put money into Coinbase, it doesn't fit into their AUM, their assets under management. So they will not get paid on it. So that's a very simple reason why they don't go to Coinbase. You create an ETF, advisors will be able to allocate to that, and they will get paid on those assets under management.
So under the current dynamic, if a financial advisor is managing $1 million of somebody's wealth and they told somebody, you should put 10%, you should put $100,000 in Bitcoin, they'd have to take that $100,000 away from the financial advisor. So he'd only be managing, so his fee would go down by 10%. He'd only be managing $900,000. They'd go deposit in Coinbase. So it completely cuts him out of it. And then he can't monitor it. He can't see, if that doubles, if it needs to be rebalanced in their portfolio. So they also are depriving themselves of being able to have his advice. So how do some of the products like the exchange listed products, ETFs and closed-ended funds, how is that different? Are those products that financial advisors can distribute and would be incentivized to distribute? And do you see that already happening, or is that coming later?
Well, it's obviously with this is the big reason why everyone wants to see a Bitcoin ETF, and the problem has been that the heads of wirehouses, people in the financial industry, people like Jamie Dimon, and others who have basically been dismissing Bitcoin and not allowing the investors to invest in it. That's also bled over to the government, and the government has not moved at all on making any sort of a decision on giving an ETF approval. We have that up in Canada. We don't have here in the U.S. So advisors basically just say, no, you can't go into Bitcoin. You can't do anything along those lines. Even GBTC, which is the Grayscale product, that trades on the pink sheets, and most wirehouses will not allow that to be placed in a portfolio. So that's not a solution. So ultimately, when we do have the ETF, advisors will be able to put it into portfolios. They will get paid on those assets. What's very interesting right now is what we're seeing. And you've got to remember, in the retail industry, there are wirehouses, Morgan Stanley, Merrill Lynch, and then there's RIAs, registered investment advisors, who are the independents. What we're seeing is the independents who have a little bit more flexibility have stepped up. We've got guys like Rick Edelman, who I think he runs the largest RIA in the world probably, and he stepped up and he is saying that he wants to put his investors into 1% into Bitcoin. Now, there are not products out there to do it, but they're a little more flexible in being able to discuss it and potentially helping to manage what's over in Coinbase. And they're a little less concerned about providing decisions on something that's held away. Additionally, what we've started to see are separately managed accounts that are now being used by RIAs. There's a number of them. I'm involved with one business called Eaglebrook Advisors, which has stepped up and been one of the first separately managed accounts that allow RIAs to put money into either a Bitcoin portfolio or Bitcoin and Ethereum portfolio, and have it sit under your assets under management. When you get a report from that advisor, you can see all of your stocks and you can see all of your Bitcoin holdings. But still, we see that once we get the Bitcoin ETFs approved, you're going to see a true domino effect, and financial advisors are going to be stepping all over themselves, talking about how great Bitcoin is and how great crypto assets are. And the reason is not because they've just discovered it, but because they finally have gotten approval to put it into a portfolio. But more importantly, they now have the ability to get paid on those assets. So that's why, I mean, we're probably going to see a lot of ETFs come out, but it's also going to be very important for investors and advisors to be able to judge those ETFs, because they're very different. Every ETF is very different. Fred can talk about this. I mean, there are many differences between ETFs, and a lot of that is going to fall to the financial advisor. The client's going to say, I've got all these ETFs out there. Which ones should I invest in? Or which one should I invest in? And help me to make that decision. And so that's where the financial advisor really provides value there.
So, touching upon the difference between different types of products, ETF is often used as kind of a catch-all term for all kind of Delta One funds, or funds that give kind of low-cost passive exposure to and are listed on a major exchange to an asset class. But actually, it can be more nuanced than that. And there are key highlighting some important differences that financial advisors and investors should understand. One of them is actually the difference between what the regulator calls an ETF, which has a different actual definition to what many people think of as ETFs, but are actually exchange-listed closed-ended funds. And there are some key differences. Again, obviously 3iQ has, it's very well known that they have multiple products listed on exchanges in Canada, and are working on something in this region as well, in the Middle East, in partnership with NASDAQ Dubai. But I think that it's important to understand what, Fred, if you could maybe explain what are some of the key differences between what a regulator calls an ETF and what a lot of people are using as the broad term, but are actually exchange-listed closed-ended funds. What are some of the advantages of each, and what's been your experience on ultimately at the end of the day what investors care about, which is their performance?
Yeah, that's a great question, Zach. And I think everybody is aware that 3iQ launched their first regulated ETF about 8 days ago, and it's already crossed over $1 billion in AUM. And I think what's important is, you're right, the catch-all phrase of ETF is very different. We've had in Europe, for example, there are many ETPs. Our business partners at Valour, our business partners at CoinShares have some of the largest ones there. And those are mostly debt instruments that replicate the performance of Bitcoin. Some of them do have physical backing of Bitcoin behind them as their hedge. So they're also very good products. In Canada, the first ones that were allowed were the physically backed closed-end funds. And the reason being is there were a lot of concerns by regulators on market manipulation, on liquidity, and everything else like this. So the reason and this was discussions we had with DAC and some of the big providers in the United States, VanEck, who's a 10% owner of 3iQ as well. I sat with Jan VanEck and I said, you know what, I think that we have a better chance of getting a closed-end fund approved in Canada before you get an ETF approved in the United States. He says, you know what, you're probably right. He made an investment in 3iQ, which was also a right decision. Having said that, the difference between a closed-end fund and an ETF as per the regulator. First of all, a closed-end fund, if we raise $1 billion, we go buy $1 billion and it sits in a pool, and that pool is now sheltered. That pool matches 100% the price movement of Bitcoin. Now, so we've packaged $1 billion of Bitcoin into a security. Now that security trades on bid and offers, so it may trade at a premium and it may trade at a discount, but it will always be valued every day at its net asset value. Now, if it trades at a premium, as they historically have done in the Bitcoin space, the fund itself can issue more units. And they issue units at a premium, it's the current shareholders that make the benefit. If it trades at a discount, the fund itself does what's called a normal course issuer bid and buys itself back up. And again, it's accretive to the current unit holders. So a closed-end fund can actually outperform the price of Bitcoin after management fees, such as ours since December 31st, we're about 300 basis points ahead of the price of Bitcoin. Now the ETFs, it starts the day at net asset value, ends the day at net asset value, but all day long it trades in a wide band, and it's the traders making all the money in that band. But the ETF has to buy Bitcoin all day long. So if Bitcoin starts, and I'll exaggerate, starts the day at 50,000 and ends the day at 60,000, they've got to buy 60,000 Bitcoin at 60,000 when everybody paid $50,000 worth of value. You call that leakage because that's destructive to the current ownership of the ETF. And the experience in Canada is the first 3 or 4 ETFs that came out have not been able to be anywhere close to matching the actual price of Bitcoin. They're actually Bitcoin less, some of them are as bad as Bitcoin less 0.5% or 1% a week. So that's really an important difference. So you have to look at what structure you want. If you're looking for a tight trading structure, you want to look at an ETF because there's unlimited liquidity, all intents and purposes, and you can get in and get out on any given day without massive premium or massive discount. But if you're looking to buy and hold Bitcoin, you want to hold it in a closed-end fund structure.
So okay, so once we understand, again, the types of products that we'd like exposure with, we see some of the advantages, for example, of listed closed-ended funds, ETFs. Jack, I mean, if talking to financial advisors, I can see a lot of financial advisors on this call. Several are asking questions. Some are about specific products, so we won't be able to touch upon those. But if when you're talking to financial advisors, what are some of the reasons that, if you're talking to the wholesale teams, if you're talking to the teams that decide on the product coverage, what are some of the reasons that they should cover some of these products, make them available for their RMs, for the relationship managers and the teams to be able to distribute to their clients, assuming that those RMs are convinced that their clients should have, 5 to 15% of their portfolio or their clients' portfolios in Bitcoin.
Well, one of the major challenges that financial advisors have, and part of this has been created because of the management of their firm, is education. So many of them are not that knowledgeable about Bitcoin. They're very much behind in terms of their full knowledge of it, and their awareness, and even the difference between a Bitcoin and Ethereum. And you start bringing up things like DeFi and gaining yield on some of these crypto assets that they've never heard of. They're unaware of these things. So education is a big factor that advisors need to become aware of. Additionally, I think advisors spend all day talking to clients about their portfolio, rebalancing, taking a look at allocations, and trying to identify new opportunities for them. And I think just going back to the basics, getting away from what Bitcoin is and where it's going to be in the future, and just thinking about a client's portfolio and providing enough allocation and enough construction that allows them to take a look at an alternative asset like Bitcoin. I think just goes back to how advisors have been trained and looking at the different portfolios. But what's the concern that I have with many advisors, and I hear from many advisors, is that the older clients, they may be less inclined, they may be a little more conservative. But then the younger clients are, for the most part, not working with advisors because the advisors are not bringing this up. So what's going to happen in 10, 20 years? You're not going to have, you've basically lost the millennial investors. Now, advisors will say, well, financial advice always is worthwhile and all of those things. But the whole financial structure has been pushing away smaller investors and, in essence, younger investors. And they've gravitated towards things like Robinhood, Coinbase, and those types of things, and doing things on their own. So, and I hope that we don't see a point where financial advice becomes a commodity, but we're starting to see it robotized. And that is a real challenge to the financial advisor industry. They're going to lose the millennial investors. They're going to lose investors who basically, at some point, an investor is going to look at their advisor and say, you didn't put me in Bitcoin. You didn't even bring it up to me. And my son or my daughter had brought up this Dogecoin, and they now have enough money to pay for college. Well, I'm still barely making 5 or 6%. You've told me, well, that's good. So there could be a backlash here that advisors are going to run into. But my fear is also, and Chris and I wrote about this in the book. It was one of the last chapters in the book on how advisors can lose the younger investors, the millennial investors, because they have got their arms around it. They have got the open-mindedness. They are more inclined to see what's going on with crypto assets and put their money into it. And I applaud them for doing it. But I also recognize the value that a financial advisor provides to tell people, do not put 100% of your money, do not put more than what you can lose into crypto assets. Now, you may put 10% of your portfolio into crypto assets. And at some point, when you look at it a quarter later, maybe 50% of it is now into crypto assets because of the gains. Well, that's where a financial advisor comes into play. So a financial advisor has a lot of value to young and old investors. And the sooner that advisors get their arms around and have the ability to discuss crypto assets, the more advantageous for their own business, and ultimately more advantageous for investors, specifically the younger investors, who will say, yes, now I need this financial advice. I may have made some money here. I was part of the boom, but I really need some financial advice. And that's where a financial advisor can really provide value. But we've got to start getting financial advisors to get education, awareness, and start to integrate crypto assets into portfolio construction and into asset allocation.
So let's again. I'm operating under the assumption that that is happening and will happen with products like the 3iQ products becoming available. With so much education, so much demand for this asset class, we're already starting to see it. We're seeing that the institutional wholesale onboarding of this asset class and then making it available for their private wealth teams. Because again, what the financial advisors are seeing is that if we don't offer it, the money leaves. Right, the money, there's too much demand for it, then the money leaves our ecosystem and then goes direct. And for just for the business case, but actually also for regulators that are concerned, where is that money going? Is it, there are several credible, reputable regulated exchanges, but there are also, for every one of those, there's 100 that aren't. Right. So, keeping it within the ecosystem and keeping it within is also in the interest of regulators. Fred, if you don't mind, I just want to ask Jack a little bit more about this. Let's say we tick all those boxes. Let's say, the financial advisors start offering it and start thinking, okay, starting conservatively, 1%, 3% of my client's portfolio might be in this kind of in crypto assets. How big is the pie that we're talking about? I mean, last week when we talked about, when we had this session with Tyler Winklevoss, he was saying, highlighting how there's, out of 5,000, regulated listed firms, there's only, I think, 24 or something that have any Bitcoin, so that we're at the, very early innings. I think you said the first pitch of the second inning or something of the crypto industry. I think in the financial advisory space, how big is that pie? How much money is sitting with financial advisors and with wealth managers globally?
Well, I don't know the exact numbers because obviously, I'm not directly in the industry, but, you just take a look at a firm, let's say a wirehouse such as Merrill Lynch, and, Merrill Lynch may have 10,000 financial advisors, and an average account is $1 million. So you can start to see where the numbers go, and start to see 1% of that or 5% of that. It becomes huge. I remember when we were writing the book, and it has been brought up. It has been brought up lately. If you just take a look at gold as an investment. Now, remember, most financial advisors probably are offering, gold ETF to their clients as part of their asset allocation. If Bitcoin was able to take, I think we were looking at a number about 10% of the gold market, then that would equate to Bitcoin being worth about $100,000, which we're approaching. And I think once you turn on the ability for a financial advisor to offer a Bitcoin product, whether it's closed-end fund, which is Fred's mentioned, there's a lot of advantages of that, or an ETF, and you start pulling out of gold and potentially, and I'm not saying you should pull out of gold, I think they're complementary, but once you have that ability, like I said, just 10% of what's in gold would translate into, I think, a $100,000 number. You go beyond that because of the interest, youth being more interested in investing in Bitcoin than gold. And I think the whole story about gold is really being, cut down a bit, but it still has its purpose. You start to cut down where gold is, and you can see that number for Bitcoin go way above 100,000. Where if it becomes 20% of the holdings in gold or 30% of the holdings in gold, and that's just Bitcoin. That's just Bitcoin. There are thousands of crypto assets out there. And one of the things that's most exciting about this space is that you right now in the crypto asset space, you have the top developers. I mean, we saw this with the internet. When we had the internet in Silicon Valley, the top of the top, the talent pool went and worked on internet-based products. That talent pool is now working on crypto-based products. You are going to see so much innovation, so many new enhancements and new products come out of this, that this is going to be a place where if you're a financial advisor, you better get on top of this, because the whole DeFi space, the allocations, the innovations that are going on there are something you've got to make note of. NFTs, DeFi, all of these things, these are the next phase. So if you're a financial advisor, you not only have to play catch up with Bitcoin, now you got Ethereum, now you've got DeFi and NFTs and all of these things, and you've got to get ahead of this. So there's no longer the point of saying, I just need to learn a little bit about Bitcoin, or I've got to just put a little bit of Bitcoin. You've got to get on top of this in much the same way as when the internet came along and people were like, okay, we'll get into the internet. It'll be something. And well, now we see the FANGs, we see all of these things. It's going to be that way 5 to 10 years from now, when you start to see all this innovation that has been created out of crypto assets. So, you know, the numbers, you can talk about the numbers and everything else, but it's the wave of where we're going, the wave of innovation that crypto assets are bringing. And it's not just Bitcoin, it's not just Ethereum, it's DeFi, it's the yield-based products, it's things like NFTs, it's things like metaverses. I mean, all these things are now coming down the tube. Advisors cannot just play catch up. Advisors have to start to get ahead of the curve if they're going to advise their clients appropriately. And if they do, the amount of assets that go there will be huge. I mean, beyond the numbers that many people are talking about right now.
Well, I'm a little bit skeptical about whether financial advisors would ever get ahead of the curve, personally. But let's just talk about the numbers if they play catch up. Boston Consulting Group estimates that the financial advisory industry globally has assets under management of $89 trillion as of 2019. So, you know, using some round figures, if we took you talk about financial advisors and investors, you know, maybe having 10 to 15% of their portfolio in Bitcoin, but let's talk about, you know, having 3% of their portfolio in Bitcoin. We'd already be talking about the better part of $3 trillion, which is, you know, double the market cap of Bitcoin itself, just coming from the financial advisory industry. I think, again, even playing catch up of putting 0.5% or 1% is enough to really move the needle. I mean, Fred, you know, what kind of impact, if assuming that this nut is cracked and is in the process of being cracked, and I can tell you, you know, we're seeing it, right? We're seeing it on the ground. We're seeing the process happening of significant organizations with wealth under management, with financial advisory, working on onboarding products for distribution to their clients, and ultimately selling them. So if the industry does play catch up and starts putting 1%, 2% of their clients' wealth in Bitcoin, what kind of impact is that going to have on Bitcoin and on the investment landscape of these Bitcoin crypto access products? Because ultimately, I think that, you know, this is the gateway, right? This is the way to the easiest way to get in. It's the most secure way to get in for a lot of investors who it ticks the normal boxes. So, you know, Fred, what do you see as the potential impact that this wholesale financial advisory market could have on crypto and on Bitcoin?
Well, let me show you how much it's changed in 1 year. We launched our Bitcoin closed-end fund beginning of COVID on April 8, 2020. We brought in $15 million in our first day. We launched our ETF 10 days ago. We brought in $1 billion in 10 days. So you want to see a wave, I would consider that's real life actuality. What's going on in a tiny country here like Canada that controls less than 3% of the world's worth. Having said that, we are obviously, most of our attention is coming from overseas and abroad, and certainly from the US. Having said that, I want to go back to the investment advisor. The biggest question they're getting from their clients right now is the world is printing money at a rate that we've never seen before. All assets are on the rise. They're all stretched in terms of their pricing. When does this end? You have to remember that Satoshi Nakamoto, whoever he or they are, she or they or he are, it was created in 2008, in the beginning of the other financial crisis, and it was supposed to be a response to QE1 and QE2. They said the next generation is going to be responsible for paying for the excesses created by QE1 and QE2 and the excesses of the financial services industry. Well, the QE1 and QE2 never came to a reckoning. You know, all of a sudden now we've got QE infinity, and every client is asking every financial advisor, what can I do? And they're sitting there, they're not going, well, we got to buy more Tesla. You know, you can't continue to say that. Sure, you got to be there. You got to play with the, as Jack says, the fangs. The beauty about Bitcoin is Bitcoin's both a risk on asset and a risk off asset. It plays as a store of wealth, but it also plays as a technology play. It's absolutely beautiful. The thing with Canadians and what we have to deal with the banking system is investment advisors who put in 1 or 2% a year ago are up over 600% in their first year. So therefore, their 1 or 2% is now 5 to 10%, and they're being told that they have to reduce the amount of Bitcoin or the amount of my fund they have in their portfolios, or get their clients to sign off on letting it run, because it hasn't really even, started for, after a year. We launched our global crypto asset fund right after Jack's book, and that's got a 70% average rate of return for 3 years and was up 700% this year. Like, these numbers you cannot, cannot be avoided. Everybody looking at the hedge fund statistics and all these hedge fund players around the world are going, who's this 3IQ and what are these numbers? How can it be so powerful? So, people have avoided us or avoided the space, and they're learning about it. And, people attending here today, is that what they're here to do, is to learn about how do we get exposure and what can we expect out of it?
So just pulling a question from the audience on something that we were discussing before the session, to try to keep things a little controversial, Chris Atwell has asked to provide your views on the statements made by outspoken Bitcoin haters. Charlie Munger and Jamie Dimon are just two examples. Munger said recently that Bitcoin is disgusting and contrary to the interests of civilization. Dimon suggested that governments will certainly step in and intervene, curtail it somehow, and limit decentralized crypto from threatening fiat currencies. Now, Jack, I know that this is something that you are very vocal about and that you'd love to go toe-to-toe with Charlie or Jamie on these points. So I'd love to hear your response to those questions.
Well, I don't know if I want to go toe-to-toe with them. A couple old guys going at it is not fun to watch. But I got to tell you, I mean, if I'm Charlie Munger, 90 years old with the money he's got, I'd be sitting by the pool and I'd keep my mouth shut. Okay, I'd be going playing bridge or doing something along those lines. He's benefiting no one by saying what he's saying. He's just it's kind of that, there's a couple of guys. I mean, they should just sit up there and just say, "Get off of my lawn," him and Warren Buffett. Okay, they've missed the boat. They're trying to justify it, and quite honestly, they need to move on. Okay, it's time to move on. In fact, watching that whole thing was a little bit embarrassing. Here are two legends, and I cannot take anything away from Charlie Munger and Warren Buffett in terms of what they have brought to the industry and what they have brought to their investors. In many ways, Berkshire Hathaway was the Bitcoin of its time. Okay, you had people invest in even one share of Berkshire Hathaway years ago, and it blew up. And they have this love fest in Omaha, wherever they have it. You can tell I'm a New Yorker here. And everybody gets together and they're all patting themselves on the back. Look how great, I listen to Warren, I follow Warren, and I've got all this money. Terrific, wonderful. Well, the same thing is happening with people with Bitcoin. Why are you having such an issue with it? In fact, Charlie, my message to you is very clear. If you had put 1% of the damn Berkshire Hathaway portfolio into Bitcoin, God, you would take care of your investors' dreams, their children's dreams, and a lot of money to charity. But instead, you went around saying bad things because you didn't understand it. You didn't have the space to look beyond what you knew. Okay, which is fine. When you're 90 years old, there's certain things you don't have to worry about. Okay, but when you're running people's money, you have to be basically looking beyond and what's next. And they were not doing that. And I think the investors within Berkshire Hathaway granted, they've become rich and they're very happy, and Warren Buffett's great, but they've missed the boat over the last few years. 1% they could have put into Bitcoin and the results would have been phenomenal. Instead of dissing it and calling it things like disgusting or whatever new adjective he wants to come up with. And believe me, a 90-year-old guy, he doesn't have too many adjectives left. Okay, but you've denied your investors some real gains there. And quite honestly, I think guys, look, the young guys will get off of your lawn, no problem. Go sit by the pool for a little while. Leave it to the young guys. Leave it to people who are being more open to thinking out of the box and thinking beyond what you've done today.
So I asked you to bring controversial. You brought controversial, so thank you, Jack, for that. Another question from the audience from Stephen Lister is commenting on, and so we've been talking a lot about how Bitcoin and crypto products would fit into the financial advisors model, fitting in likely through exchange traded products, through products that they can safely put their clients' assets with and distribute, and fit in with the business model of this $90 trillion industry. But Stephen has asked about the recent advocacy from those of like Michael Saylor for holding Bitcoin and crypto as a treasury asset and as part of the treasury strategy, given that cash is devaluing at an accelerating rate, massive global printing of money. I mean, Fred, we've talked about that briefly, but it would be great to understand how are the Teslas, how are the MicroStrategies, how are the organizations and institutions that are looking at this as a treasury strategy rather than as part of a strategic asset allocation that are not kind of what we would normally think of as investors. Why are they getting into this, and why are they moving seemingly faster than the investment industry in a lot of ways?
Well, let me talk to you quickly about one of I've done a number of presentations to boards of directors of corporations that are asking that exact question, Zach. Do we put our treasury into Bitcoin? What do we do with what do we do with it? And specifically, there have been a couple of Canadian gold companies. Canada is well known for gold mining. We are all big gold bugs here, always have been, always will be. I'm a big proponent of if you own gold, you should own Bitcoin, and vice versa. So talking to some of the boards of these gold companies, if a gold company were to announce tomorrow, well, they've got $100 million of Bitcoin on their balance sheet, do you think their multiple as a gold company increases? Of course it does, right? Because they've now hedged their own balance sheet with two defensive products. I think it's a win-win-win situation for all gold companies in the world. And they come to people like us. They say, we don't mind paying you a small fee to be able to package this, do this. Our fiduciary responsibility is to work with a regulated company that understands all of this, because we don't necessarily understand it all, but we have to do it. Now, having said that, we've always laughed that in our industry, everybody says, well, you can buy a Tesla using Bitcoin. It's the other way around. Elon Musk is buying Bitcoin by giving away Teslas. So he's turning a depreciating asset of a car into an appreciating asset in Bitcoin. So we do believe that balance sheet diversification to not just cash or not just equities is a wise idea.
So, Jack, I'd love to kind of hear, I think you have also worked closely with some of these corporate investors and treasuries. How is their thinking different from the financial advisory thinking in terms of allocation to this asset class? Is it strategic? Is it tactical? Or is it a combination of both?
Well, I think the situation with corporations putting money into Bitcoin, um, you've got to remember that there's a lot of things at play there. You have shareholders in place. So the last thing I think you want to do is you want to get into a situation where you're putting the majority of your money into Bitcoin, because if it does go down, which we've seen volatility within Bitcoin. I mean, remember a year ago, Bitcoin was trading at $3,000. So the volatility is there. So if you do that to a shareholder, that's not going to bode well for anybody. So it comes back to the whole point about allocation and proper allocation, and anybody running the balance sheet of a company is going to take a look and say, look, we've accumulated all of this money. We're taking care of it for our shareholders. Where do we get the most value for it? And they're identifying the fact that right now the dollar is an inflationary asset and Bitcoin is a deflationary asset. So there's an advantage to going into Bitcoin to protect the balance sheet. But in much the same way as a financial advisor has to look at a client's portfolio and say, I'm allocating it to this percentage of it where it fits. I think the corporations have to do the same sort of thing. And I think Elon Musk, he should be congratulated for what he's done as well, but also, he's having a little bit of fun with everyone here. He's had some fun with Dogecoin, and he's also sold some Bitcoin, and he's made some money here. So he hasn't really burned his investors. But at some point, if people go beyond what's considered a prudent allocation into Bitcoin and into crypto assets, that's where they're going to get in trouble with not only regulators, but specifically shareholders as well. So I think there's a place for it when you start to take a look at your balance sheet, take a look at your treasury funds in much the same way as any investor should be looking at their own assets. But I also caution them to be very careful on how far you go with this. I mean, Michael Saylor has, he's become a Bitcoin bull, and to a certain point, certain extent, his company is more of a Bitcoin company than anything else. And we're starting to see a lot of equities become proxies for Bitcoin more than just corporations. But I think a lot of these companies have to recognize that they have to be prudent to their shareholders and board decisions and things along those lines. Now, that being said, they should still consider crypto assets as something to take a look at in regards to its deflationary aspect in conjunction with having dollars in their portfolio, which is an inflationary asset.
So going back to actually the discussion around ETFs, closed-ended funds, some of the products that exist around, like those that have been sponsored by 3iQ. Fred, there has been a dynamic since these products came into fruition of them trading at premiums or discounts to NAV. And you highlighted that some of the key advantages of a closed-ended fund are who profits from that the kind of arbitrage that premium or discount creates, whether it's market counterparties or whether it's the fund's investors themselves. But if you could maybe break down what are some of the dynamics that cause the premium, that caused there was a discount for a period in some products, that discounts closed. What are some of the reasons for that? Why does that exist? And what are some things that investors should be aware of when going into these products?
So the beauty about a closed-end fund is, as I said, it's the pace at which the fund actually accumulates dollars and then has to go buy Bitcoin. You have to find a very special opening window to be able to buy any size. Even though our closed-end fund is $1.5 billion fund and trades $100 million a day, sometimes there's demand for $200 million worth, and it goes up to a 5 or 7% premium, like it did. So we do have the mechanics now to keep it in line, but a lot of people were suggesting when we first launched and it was at a premium that they didn't want to buy it at a premium. Well, being up 600%, their 5% premium at the beginning doesn't mean a lot later on. it's worth a premium and a management fee to pay to get access and to pay to have a digital asset manager such as ourselves run it. So, I mean, we're very comfortable with the closed-end fund, but more importantly, Zach, as you know, our target is to have this fund. Bitcoin trades 24 hours a day. Look for 3iQ to get exposure or listings in the Far East and the Middle East, as you know, Europe. Look for us to be in South America. We want to be pretty much on all continents and in all places.
So going back to, we actually touched upon briefly the some of the trends in the financial wealth management industry, and Jack, you touched upon that financial advisory is the emergence of robo-advisors that kind of set a target strategic asset allocation and automatically rebalance clients to that at a very low cost. And that a lot of millennial wealth may go to this. Now, my understanding is that most of these robo-advisory products and firms invest exclusively or almost exclusively in ETFs. They're allocating their clients to ETFs and balancing the portfolio of ETFs, how much is stocks and bonds and so on and so forth, based on the client's risk parameters and some things that they know about the client. If we're looking at a world where crypto is becoming an asset class that financial advisors and robo-advisors are allocating clients' wealth to, where do you see this fitting within the kind of robo-advisory strategic and tactical asset allocation algorithm?
Well, you bring up a good point, because ETFs have become kind of the path for these robo-advisors to go. And whether that's good or bad is a point of discussion. But I think what's going to end up happening is you will see Bitcoin ETFs, especially in the large countries, which will start to fit that sleeve of the alternative asset, and the alternative asset being that 1 to 10, potentially 15% of the allocation there. Once you start to have that, you're then going to see other ETFs come along, because people are going to say, well, even now, well, I'm in Bitcoin, but I'm missing the Ether run. So you're going to see ETFs like, Fred has the Global Crypto Asset Fund, which is a very simple fund. Top 3 crypto assets, and it gets rebalanced along those lines. But that's not just a Bitcoin fund. It's got some other allocations as well. So you're going to see other types of investments. You probably will see a Bitcoin ETF. Already, Fred is working on an Ether ETF. He could potentially talk about that. A crypto asset fund, which has a number of them out there. And then I also think you're going to start to see things along the lines of more yield-based funds that are going to take advantage of the DeFi space. So the Bitcoin ETF is not going to be the only thing you're going to see. And I think these robo-advisors and even just financial advisors are going to say, yeah, let's put it into Bitcoin. But an investor is going to come along and say, I'm missing the Ether boat. What do you have for me there? Well, maybe you do Bitcoin and an Ether one. Well, now I'm missing the DeFi space. So you'll have a DeFi fund. So you're going to see different ETFs that are going to come along, and those will satisfy not only the needs of financial advisors, but as you said before, the needs of a lot of these robo advisors out there who are putting money into ETFs. So that 10% allocation to crypto may become a combination of 3, 4, maybe 5 different crypto-based ETFs, and not just the Bitcoin ETF. So it'll be an interesting space to keep an eye on.
Final question for Fred from one of our anonymous attendees is, when do you see the US actually authorizing a Bitcoin ETF?
To be specific, 268 days. Because Van Eck, our partners in the US, just got postponed again. So they have up to 260 days for the SEC. and anybody, anywhere in the world can go to Interactive Brokers or to their advisor and punch in btcq.u and end up with an ETF anyway. So I think a lot of the, the flash is out of the pan, but we do have, and Jack, we did launch an Ether ETF as well about 8 days ago, and it's doing extraordinarily well. But the new products come out, keep an eye on this space, come to these webinars, because the DeFi and the income related, US dollar related digital asset income products are going to be phenomenal. And so watch the DeFi space. These are amazing products that will be starting to be launched very shortly.
Well, we are out of time. Again, I'd like to thank Jack and Fred for another interesting session. I really, enjoyed the discussion around this kind of wholesale market and how retail financial advisors are going to get access to this product. That there is, a huge attainable pie there. We're talking about $90 trillion, and I can't imagine that even 0.1% of that 90 trillion sitting with financial advisors right now is allocated to Bitcoin. So even if we go up, from to 1%, we're talking about a huge explosion in the amount of demand. That this is, that these ETFs, that closed-ended funds, that these exchange-listed products are ticking the boxes for that industry to gain access, and also for investors that also want to control their own financial destiny, but want to be able to buy products through exchanges and through regulated platforms, and are comfortable with the small fees that entails for the risk that it addresses. And you highlighted again, Fred, some of the risks and the real examples of exchanges that have blown up. The potential issues that investors could face trying to participate in crypto markets directly without having these regulated wrappers sitting beneath them. We talked about, again, how this looks in a strategic asset allocation from an investor's perspective, but how this also looks as a treasury asset, and why a lot of corporates are looking at it. Again, last week on the session with Tyler, and for those of you who didn't see it, please go to the AIM Summit YouTube channel and check it out. Very interesting session. We also discussed extensively, and again, apologize to those who asked questions about sovereign wealth funds and institutional investors allocating in space, but that was a key focus last week. But we've again also talked about the next phase, and the explosion in DeFi and NFTs and potential access products to those industries. Fred has alluded to some of the things that they have in the pipeline. I'd like to thank everybody for being part of this session. Thank you again so much for joining us. We look forward to hosting you again. Our next webinar is going to be taking place on the 17th of May at 4 p.m. Gulf Standard Time, 8 a.m. Eastern Time. We are going to be talking about a brave new world, life after COVID, a discussion focusing on emerging financial, economic, and social trends as we gradually emerge from the pandemic. That is going to be with His Serene Highness Prince Michael of Liechtenstein, the Executive Chairman of Industrie und Finanzkontor, as well as David Gibson Moore of Gulf Analytica, and sponsored by Gulf Analytica and INF. Looking forward to having you all there, and thank you for joining us today.